Alright, so basically, I'm just going to be explaining uh, how you can find demand and supply ranges. Basically, supply is just where there's a high selling pressure, and then demand would just be high buying pressure. That's basically what it is. Nothing too uh, complicated. How you can find it is basically you want to look for a candle before there was a fat move to the opposite direction. For instance, here was the candle before we had this large downwards candle, bearish candles, and then we went and fell over like what is that, $100? Yeah, we fell over $100 on SPY. And then so another one would basically be this one as well right here. This one would be a demand supply. How you would mark it out would be going from the where it opened all the way to the wick. And as you can see here, it basically wanted to go back down to it, but you know the market isn't always going to go back into that range. It's not always going to be perfect. And so yeah, and then the demand would have been from where it closed, or if it's bearish, bullish, where it opened, and then bottom wick. So you never, for the demands, or no, for the supply, you never want to mark out the bottom wick. It's always just the top wick, and then where it opened, or closed, depends. And then, but for intraday, day trading, the highest you would need to go is obviously just, to 30-minute. Since you only want to be in and out, you don't want to be in a trade for too long. So you would mark out the here before the move up, and you want to use a light color so you can sort of see it. All you have to know is that it's in there. What am I doing? And then you would mark a supply zone. Like right there. And then it has this one as well right here. So it's two of them right here. And then sometimes it's like a head and shoulders once it gets tested like this. It's like a head and shoulders because if buyers can get it over this price, then we could go back up to here. But even though we did cross this price, we already had a push down. So why would we not have another push down here? And then you would go down to the third 15 minutes, or not the 15, the 5 minute. You can see here where we opened and whatnot for SPY for May 9th. You can see we had this larger wick right here, full of supply range, where we could reject. We could do this one dark gray since it's on lower time frame and we actually need to see this. And then you can see right here, as soon as price opened, right here we had this supply range right here. Rejected it once, twice, had to push down. And then obviously none of the demand is here counted for anything except for when it came up to here. You can see here we rejected, then rejected again. We didn't surpass where it had opened. And then come down here, and you would also see that before we had this push up, we had this range right here of just buying. We would use this candle. Technically it would have been this one. We kind of wicked out, but it's not always going to be perfect. And then you can do this all the way to the 1 minute chart. And you would just look for the same ranges. For instance, here again, basically head and shoulders. Price didn't go above it, and it just went down, came and tested it again, boom. And guess where it went? To this demand zone. So basically, all price does all the time is move from zone to zone. So basically went down, boom, there was a demand. I'm at supply zone, boom, supply, demand, supply, demand, supply, demand, supply, demand, supply, demand, and then boom, boom. That's basically how price hops around. Just a bunch of algorithms, and 70% of the market is made up by that. And it can help you out if you actually invest, and where you could buy stocks. For instance, here on April 1st, 2025, you would have bought in at SPY at 480 something, and then you could have sold it at like $565, almost $100, almost. That's how you find demand and supply for any stock, futures, forex, anything like that.